Welcome to this week's show. This podcast is for discerning investors, people who are serious investors who want to make their money grow. We discuss many aspects of investing in shares, and we feel that our ideas, if you follow them, could really make quite a difference to your life. Obviously, we're not making recommendations. This is just our opinions. Obviously, prices of shares can rise or fall. You may not get back the full amount you've invested. So, without any further ado, let me introduce you to my two eminent colleagues, Carl Roberts, fellow director, and Awet, who's our head of research, no less. As we usually do in this show, we're going to talk about some topical items of news. And of course, there's been an awful lot going on just in the last week or so. So, Carl, what is it you want to discuss this week that's topical?
Yeah, so at the time of recording this, we've just come off the back of an US election victory for Donald Trump. The man's back. He's back in office. I think it's only the second time a president's been re-elected with a sort of a gap in between. Yes. So, yeah, the man's back, and it's a more decisive win than ever, really. I think he's got control of both houses, so the House of Representatives and the Senate. So that should mean he can push through a lot of his agenda, really. Yes. I think in terms of what impacts this has, obviously no one really knows. We don't know for sure what's going to happen in the world. I wouldn't get some people get really worried about Donald Trump, whether you like him or not. I don't think a lot of it's just bravado, isn't it? Newspaper talk and things. In my experience, very little really changes in politics, particularly in the US, because I think in another 2 years they have the midterms, don't they? And it generally, whatever party's in power, the other party takes over one of the houses, and then it kind of puts a block on everything until the next election. So I don't think that much changes, in big terms. But I think predictions are that it'll be generally quite good for stock markets because he's pro-business, isn't he? Low tax generally. It does sound like he wants to bring kind of tariffs into trade, which could cause some issues. But yeah, generally good for stock markets. The stock markets did very well last time he was in power. Interestingly, he's come out and said during the election campaign that he's quite pro Bitcoin, which is a bit of a change from the normal Western view of it. He's even gone as far as to say that he doesn't want the Federal Reserve to be selling any Bitcoin that they currently hold. So I think they hold Bitcoin at the moment. Sometimes it's confiscated from criminals. So the sort of FBI and things have confiscated Bitcoins off people. So he's basically said we don't want to sell any Bitcoin. We don't want to hold that. He's not said it's going to be a definitive, official national reserve of Bitcoin, but it's kind of going down that way. So that's really interesting to see what will happen with that market. And obviously off the back of that, Bitcoin has gone to new record highs.
Yeah. So, that's interesting because other countries in the world, particularly the BRICS countries, they're building up their gold reserves.
Yeah.
But it sounds like the US could be more keen on Bitcoin. Interesting.
Yeah, definitely. I mean, I think he's sort of he wants less regulation on it. A lot of some of the big funders of his campaign were funding in Bitcoin, even the likes of Elon Musk and things. So yeah, it'd be interesting to see what happens there. I think ultimately, though, it's a Western country, still going to be more debt. I don't think there's any plans to cut government spending. So
no,
yeah, he'll increase the debt pile over that period. So we're still on that kind of trajectory of unsustainable debt.
He's definitely a borrower. But that's something you wanted to comment on, didn't you, Awet, about the US public debt position?
Yeah, I mean, if you look at, Carly was making a statement about Donald Trump in power and he's, reducing tax. But if you look at the US debt they have 35.7 trillion in debt, which is thus 122% of the GDP. It took 200 years for US to accumulate 12 trillion in debt. But in the last 5 years, they accumulate pretty much more than that. So the question is the US is paying 1.2 trillion annually on interest on that to finance its debt. And that's actually 23% of the revenue that they receive from taxes and tariff and other fees. So reducing taxes, I'm not sure how good is going to do to the US economy, because their debt is becoming unsustainable. When you think about it, the interest that they pay in 1.2 trillion, that's actually the same size of the Saudi economy or the Netherlands economy or the Turkish economy, similar size. So you have a debt that US is paying the same size as the Saudi economy. And in the long run, that's not sustainable, because if you read my blog recently, I've wrote about the Japanese old companies. And when you study them, they survive hundreds and hundreds of years. Is the reason is for their longevity is debt. They don't take much debt. They just have enough reserve, and they sustain their relationship with their customers. That's the key to their longevity. And we see that in the Western countries, debt is becoming unsustainable. Even the UK, 100% to GDP, the recent debt to GDP, and it's rising. If you look at Spain, Italy, and Japan, it's just rising. And at some point, you just think this is not sustainable, especially if we had to go for a war, which you will have to raise more for the war. That's just completely is going to destroy the country's credibility and the US dollar, as you mentioned earlier as well, Tony. That's why the BRICS are getting together and forming an alliance. And I think if you look at the BRICS recent settlement out of 194 countries, almost 150 something agreed to settle on that payment. So that's huge. There's an alliances forming, and countries like Saudi is selling their treasury, and China is selling their treasury and buying gold and so on. So that's the main risk they can see is coming.
All leads to more inflation, doesn't it? I think end of the day.
Yep.
Because the US is going to have to keep their interest rates low, because if they let them go too high, they wouldn't be able to afford the interest payments. It would just swamp everything else.
They've got to just inflate it away. There's the only thing, obviously, you've either got growth, which, most Western countries now, you hardly see any growth, do you? So unless AI is going to completely revolutionize the world and make all these productivity gains, the only way they've got to get rid of debt is inflation, isn't it?
Yep.
That's traditional way of doing it. I wanted to mention the Labour budget. You two guys are focusing on the US, but I'm more concerned with some news nearer to home. We've just had a huge tax raising budget by the Labour Party, which I was dismayed about, to be perfectly honest, because Rachel Reeves described it as a budget for growth, and all I saw it was a budget for tax raising, unashamedly, and it's just hitting the wealthy, the entrepreneurs, the wealth makers, the job creators, and unfortunately, I think it's going to have the opposite effect. First of all, it's not going to raise much in the way of taxes, because people tend to pay less taxes when taxes are high. Perverse result, you tend to raise less taxes, and also it's going to just lead to greater long-term poverty. I personally have met some of these entrepreneurs who are absolutely determined to emigrate away from the UK, and we won't attract many new ones, especially with this new non-domiciled rule, changing the rule for people that have got a non-domiciled in the UK and taxing them on their worldwide income, which never used to be the case under this new residence-based scheme that's coming in. What I found particularly shocking was this raid on pensions, bringing pensions into the inheritance tax bracket in 2.5 years' time, which is unprecedented, and it will have a massive effect on people. And I think it will deter people from saving in pensions. Unfortunately, have the opposite effect, because it will mean if people don't pay into pensions, they're going to be more reliant on the state to support them. So again, I think it's a measure that's just going to have an opposite effect. So unfortunately, I don't think it's a good idea. You've mentioned the borrowing. Well, what people don't necessarily realise is it wasn't just a budget to raise an extra 40 billion a year in tax. The government is going to borrow an extra 36 billion a year. It's got to be paid back at some stage. How about reducing the public sector? How about like they're doing in South America? You just mentioned just now, Carl. Why not do that? Because there does seem to be an awful lot of waste there. Anyway, so I fear that it's not been a very good budget, a very negative one, and it will have the opposite effect. It won't cause growth; it will cause the opposite. It will cause decline, unfortunately. But unfortunately, that's the pattern of the Western world today. We just seem to be making
what country has ever taxed their way to growth?
Well, it leads to that old saying of Winston Churchill's, the, 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 the idea that you can tax yourself into wealth is like standing in a bucket and putting yourself up by the handle.
Yeah, I think
It ain't going to work.
it doesn't work. I think even Milton Friedman has saying debt is ultimately is a tax. You will have to pay is a tax. Either you pay in tax or inflation. So the
Yes.
government is borrowing, but they will have to either tax us or we have to pay
Yeah.
it through
Ultimately,
inflation.
it just impoverish us. So that's a bit
Yeah.
of a shame. Anyway, there we are. What we should really do now is move on to the main topic of today, which is quality investing, which is quite nice because that is actually our fund, the Intelligent Wealth Fund style quality investing. So I suppose I'd kick off with defining what is quality investing. Quality investing is an investment strategy that focuses on financially sound companies that have a history of solid earnings. Investing in quality companies is an approach that can be traced back to world-renowned economist and mentor to Warren Buffett, Benjamin Graham, who wrote this famous book, The Intelligent Investor. So over to you, Carl. What are your comments and thoughts on quality investing?
Yeah, I think it's worth mentioning, if you haven't listened to two of our previous episodes, we've covered a couple of other different investment strategies, one being value investing and the other one being growth investing. So today we're focusing on quality. So these are all different types of strategies you can use with your investments. And again, like the other two, I think it's kind of subjective to what you believe is quality, because obviously you don't really invest in something unless you think it's going to grow. You don't invest in something unless you think it's a quality investment idea. So it's a bit kind of, people get caught up in what the true definition is of quality investing, but actually it can be whatever you want it to be. But generally, if you're looking at quality investing, it's people, rather than focusing on sort of price as such, you're looking at very much the fundamentals of a company. So that could be, to start with, just strong financials. So, very low debt, good cash flow, good profit margins, those kind of things. There's other objectives, such as the company's competitiveness. Does it have that? Warren Buffett famously says that moat around the company. Is it immune from kind of competitors being able to take its market share? That could be a factor you're looking at. A good track record of earnings growth is another measure that most people will use if they're a quality investor. And also, its ability in kind of downturns. Is it one of these companies that's a bit immune to kind of shocks in the market? So what you tend to find with growth investing, as we've already covered, is that tends to do really well in bull markets. So when the economy's strong and everyone's comfortable and happy, people will take on more risk. These types of companies grow a lot quicker. But quality investing tends to stand the test of time. So if the market goes into recession, a quality company should be able to get through that recession without issue. So that's another kind of factor that investors look for. In terms of, has it been a good strategy? Has it been successful over the years? How does it compare to kind of value and growth style investing? Well, if we look at the last kind of 10 years, and this is using the MSCI All Countries World Index, Growth Index, Quality Index, and the Value Index. If we look at over the last 10 years, so annualized returns for the Value Index have been 8.91%. For the Growth Index, it's been 14.16%. And for the Quality Index, it's been 14.85%. So the Quality Investing Index has been the best performer over the last 10 years. And that's also the same if you look even longer. So if you look back at the last 30 years, quality investing has generally been the best performing asset. Growth's very close to it, just behind, but they've both kind of beat value investing. And as we've covered previously, one of the reasons for value investing underperforming is because there's been such low interest rates for a long period up until recently. So it has been a kind of a successful strategy to follow if you can identify those quality companies. In terms of some of the downsides to quality investing, what could go wrong with it? You generally, because you're not focusing on price, you generally might pay higher prices for a good quality company, because if a company's good solid company, people are going to pay more for it. So you do have to watch what you're paying for companies in that space. Obviously, they don't tend to be high growth companies; they just tend to be solid, earners.
Yeah.
But having said that, it has performed well to the growth index. And again, but it would tend to underperform in growth markets. So if we've got very low interest rates, markets taking off, then you'll find that growth will outperform quality companies. And sometimes you can be kind of concentrated in one sector, because if there's a particular sector that's got quality characteristics, then all the companies that are in that sector will likely be quality companies, and then will form a bigger part of that index. And I suppose the one other thing to mention is you might limit yourself in the kind of emerging market space. So quality investors don't tend to own much in, like such kind of China or the East, where there might be all these new kind of exciting startups, but because they won't tick a lot of the criteria for quality investors, you'll tend to miss out holding some of those stocks. But yeah, a proven good strategy.
Sounds really good. And presumably, when markets go down, when you're in a bear market, quality companies don't fall as much.
That's generally the idea. Yeah, they're more bulletproof in recessions and things.
The reason is, well, if you look at this quality company, even if you look at individually within the 4% research that was done, which is the 4% that they generate wealth for investors, what you found deeply is these companies they provide a service or a product for our basically our basic need. And what you find is, like, when you look at companies like Amazon, what they do provide things that we need daily. Apple, a phone that you need daily. And you find Microsoft, a software that you need daily to do anything. And you find the same Alphabet to research things, to go and buy things online. So it's a powerful, I think this is a company that you learn within them. You find their quality, but they provide foundation of things that we need daily, and we rely on them. We're vulnerable without them. And I think Warren Buffett, who realized that when you look at Warren Buffett portfolio, what you find out is Apple was the biggest, and then followed by Bank of America and Coca-Cola and so on and so on. What you find is those companies are actually, they are foundation on, we need them in our daily lives every day. And he realized that that's the key thing. And in return, those companies have a power to generate high return on their investment and capital, and that can be reinvested and to grow the business over time. It just becomes a compounding machine over time, and that's what investors can benefit from.
Awet, can you think of any other examples of companies operating this theme? And I'm particularly thinking about our fund. Have we got any companies
Yeah,
you can refer
definitely.
to?
The company that I brought today is two. There's first one is KLA, which we invested in the fund. Since we invested 2 years ago, we are up almost more than 200%. And KLA is pretty much not popular. Not many people know about KLA, but it's a high quality leading semiconductor equipment provider globally. And they specialize in processing control, specifically for metrology and inspection, which means is measuring and checking semiconductor defect, right? Before you deploy them, they have to be measured, and there's a software to do that. At KLA, that's what they do. And their market cap is around 890 billion, and they are run by a visionary manager. He's been with the company for 36 years. And they have a strong track record of buying back and free cash flow and dividends in the last 10, 20 years. And they control around 50% market share in that segment. If you invest in KLA in the last 5 years, you would have generated around 31% compounded annual growth rate. And this is a quality of KLA. If you look at company, what differentiate between quality and non-quality is when you open the balance sheet, what you find is the return on asset or investment is significant in comparison to the industry average. For example, in KLA, return on invested capital in the last 5 years on average has been around 38%.
Wow.
And return on equity 96.5% in the last 5 years. That's an average.
Amazing.
And you have return on asset 23.4% in the last 5 years. So it's a company that when you look, that's why I think Warren Buffett, that he doesn't look at company. He doesn't really need to speak to the management. He just look at the balance sheet, and he just be able to see if you're doing well, if you have a competitive advantage, you will have a significant margin and return on your investment. If you're not, that's why the supermarket is very known. When you look at their balance sheet, the margin is very small because it's a competitive market. You can't make much money because everyone is selling the same thing. So yeah, KLA is a great investment we have made so far, but the downside is around 40% of their revenue comes from China, which the management are planning to reduce by 2025 to 30%. But that's an exposure from China, and there is still small competition from companies like ASML and Applied Material. But overall, it's a great company. It's been, if the complication of semiconductor is going to increase, KLA will be one of the beneficiary to benefit from this AI and hyperscalers and data booms and so
on. Any other companies you'd like to particularly mention?
on. The
Especially if they're in
second
our
one.
fund.
Yeah, the second one would be Games Workshop. You probably know Games Workshop.
Yes.
It's not popular, but what they do is not very popular. But if you look at Games Workshop, what they do, they are pretty much known for Games Warhammer franchise. And if you look at the company, 80% of the sales comes from international markets. So 20% is only UK. So significantly are from outside the UK. And if you look at the compounded annual investment in the company in the last 5 years, you'll be 21.4%. If you invested in the last 5 years, you would have 21.4% compounded annual growth. And this is why I think you see the KLA and Games Workshop, they have high return, unusual. Return on invested capital is 66.7%.
Wow.
And
That's
return on
high.
equity is around 59%. And return on asset 41.5% in the last 5 years on average. So you can see the quality between quality and non-quality is just by looking at the return on investment and profitability is significant higher. Above.
But Games Workshop isn't just an online company, though, is it? They've got these physical figures, haven't they, in their war games, haven't they?
They do, and the interesting part is they have a partnership with Amazon recently to basically to create a Warhammer TV series that could potentially expand the brand and reach to attract new fans. I think that's the key thing, and if you look at the royalty as well, IP has been rising. If that partnership pays off in the long run, I think that would be critical for the company growth. And I think the management are great in allocating capital. The problem you have with the company is they have limited communication with investors. So that's one thing, the downside. But overall, it's a great company. It's been great for investors over the long run. Yeah, we hope it will continue, especially the partnership with Amazon.
Yeah, a good example of a British success story. We don't have enough of them, unfortunately.
Yeah, I think the key thing to remember on this though is, price is still important, isn't it? Because you can pick a quality company, and it's very likely that you're not going to be the only one that's found. The accounts are public information, so anyone's able to trawl through and look at, say, the last 5-10 years worth of accounts. So it's there for everyone to see if there is a quality company there, which then means that by the time you found it, it's highly likely that the price is going to be quite high. So again, like we've always said, you don't make money when you sell, you make money when you buy. So you've still got to get that price right. And if you found a quality company, you can't just go guns blazing and say, right, well, let's invest. I mean, you might still be okay if you're going to hold that for the next kind of 10, 15 years, but you might fall with everyone else in the short term. So you do have to be careful of price.
Of course. I think Charlie Munger said it. If a company generate like 5% on capital and company who generate 30% on return on capital, even if you pay premium on the company that generate higher return on capital, you would do fine in the long run. The reason is they are traded on premium is because their quality. The quality makes them, is still when you go in the market and you buy quality stuff, you always pay premium. in comparison to the market. So of course you have to pay more, but the more you pay is worth it over time.
I always think it's great when these companies have got such a niche. They've got this financial moat we talked about earlier. Does give them this competitive advantage, doesn't it? I like the story of Hermes Paris that have produced these famous Birkin handbags, and they don't just churn them out. I mean, it takes an artisan, a very well trained artisan, 40 hours to make one handbag, one Birkin handbag. And as a result, there's no one else in the world that does it to that degree of quality. And as a result, they can charge very high prices, and they put their prices of their handbags up every single year.
Wow.
And it's almost the opposite of most normal marketing, in that you have to join a long waiting list, and you can't even choose the color. They tell you what color you can have. That's
Wow.
how dominant they are. And that's the kind of company you want to invest in, that is just so good. There's literally no competition. And that's what Buffett does. He invests in companies that have got monopolies, failing that oligopolies, failing that duopolies, failing that oligopolies. He also, like Carl says, he buys companies with a great margin of safety. In other words, he buys them when they're cheap, not when they're high. And as Awet's been alluding to, stuff that people need. We could argue you don't need a handbag, I suppose, but try telling that to my wife.
Now there's a market for it. I mean, they know there's a market for it, to like wealthy. They know them customers are wealthy,
Well,
and they love
yeah.
luxury.
And even though the
Right.
handbags are expensive,
Yeah.
they're not in terms of the quality and the durability. They can literally last decades and still be of very, very high quality. So there's not much deterioration. So if you look at it in that context, you could argue it's not as expensive as people think. Anyway, just food for thought there. So anyway, I think it's a great subject, quality investing, and there are some real great quality companies out there. It's just a question of finding them. Eric referred earlier to this 4% of companies that are responsible for all stock market growth in the last 96 years. And Eric was referring to a study by a gentleman called Bessenbinder. Carl wrote a blog on it recently. It's very fascinating. I know it's hard to believe that only 4% of stocks worldwide in the last 96 years have produced all the growth, but that's because it's highly concentrated. Like at the moment, we've got this Magnificent Seven that make up a huge proportion of the stock market gains in the US. There's always been concentrated few great companies to make up for a morass of quite average companies. Our approach is to find that top 4%. They're the kind of companies we're talking about here, and a lot of them are quality investing companies.
Right. If you look at historically as well, everything is concentrated to the 4 to 5% in the music
Yeah,
industry. On average, if you look at
yeah,
it,
true.
most of the revenue comes from the top 5 artists.
Yep,
And you can apply that in even the wealth concentration is mostly concentrated among the top 5.
true.
Historically, that's always been the case. I think there's a lot of correlation, and it can be applied to other sectors as well.
It's a very good point, Awet, and it's something we can lose sight of. Anyway, that concludes our section on quality investing. What we usually finish off with in this show, which is one of my favourite parts, is we make some recommendations based on our personal experience. It could be a book, it could be, I don't know, a podcast or a video, whatever. So let's kick off with Awet. What have you got to bring to the table this week, Awet?
And the book that we all read, I believe, 100 Bagger by Chris Mayer. And the book is basically explore 100 Bagger means is to multiply an investment by 100 times. That means if you invest 10,000, that will become a million. Basically, if you invest it, and £1, it will be £100 if you invest it. So
Amazing.
the book, the book is pretty much more about finding quality businesses and waiting, have patience to compound and think long term. Overall, that's the key things I would say from the book. Yeah, when we say if you invest, for example, 10,000 and you compounded your return 20% over 25 years, the 10,000 investment would become a million. That's pretty much it. The 100 Bagger story.
Yes, and that of course is the objective. of our fund to do that over the next 25 years. So it's quite exciting. So if you're investing with us, stay with us. Don't go. So, Carl, I believe you got a very interesting one to mention this week.
Yeah, just on Awet. Yeah, that's a really good book, Awet, the 100 Baggers one, and it's amazing that story of I think they cover Monster, don't they? The Monster energy drinks, and
Yes.
it's just amazing the rise of that company. Which and you sort of see it in the shops, don't you? I mean, I don't drink energy drinks, but you wouldn't believe the rise in share price of a company like that.
Wow.
Yeah.
Amazing.
It's far exceeded Apple, isn't it? It's been incredible growth because they've been very clever with their marketing.
Yeah.
Haven't
But I
they?
don't even
They're
feel like I
practicing-
see it that much. It's not like everyone's walking
No.
around drinking Monster energy drinks. I don't know.
No, you don't find many in a supermarket on a shelf, but they're very clever the way they designed those cans because they're very dark and sort of sinister looking. They appeal to young men, young testosterone fueled men who like that image and they like the caffeine, a lot of caffeine in the drink. I'm not sure it's something I'd ever want to promote myself, even though it's done fantastically well. So I just don't think it's a good thing for your health personally. But I suppose if you drink it in moderation, it's okay. But yeah, it's phenomenal how much that one's grown.
Yeah. So in terms of my my recommendation this week is another book. It's called The New Confessions of an Economic Hitman by John Perkins. And this is really interesting. True story. John Perkins used to work for the US government in one of these kind of quangos where he would basically go to upcoming sort of developing countries, mainly in South America, sometimes Africa, where it'd sort of go to the regime there and say, we'll help you. America will help you. You get loans from the IMF, World Bank. We've got all this construction companies in America that will come and build you all your new roads, and essentially loaded that country with a load of debt, which meant they were then reliant on the US, which meant they would allow them a military base there, allow them access to some of their resources like oil. So basically a way of America kind of invading countries economically rather than military. But what's interesting as well is that he alleges, John Perkins, that if it didn't work economically, so if the regime was kind of not on board with what the Americans wanted, they would end up sort of sending in the CIA and sort of taking that regime out violently. So it's a really interesting book. Obviously, it's from a guy that says that he was part of all of this. Don't know how he's still alive, really, and getting away with
surprising actually
saying some of this sort of stuff. But interesting. Really opens your eyes to the American. I mean, I don't think it's just limited to America either. I think he does allude to it in the end of the book that actually, a lot of Western countries do something similar.
Well, China's doing something similar, aren't they? With the Belt and Road policy, it's very similar. But what John Perkins referred to in the book, he referred to it as corporatism. It's not the CIA overtly going to these countries and forcing them pretty much to use American companies to create infrastructure and engineering and so on. The government's behind it really, but they use the companies as a cover, don't they? Really, quite like you say, it's quite interesting that he got away with it, admitting all this and didn't end up in prison or disappearing. It's quite surprising that they've allowed it. Yeah.
And it is such a shame. Some of these countries you think of basket cases, but actually it's because of the way sort of America and other countries have treated them. They've just locked them into this kind of way of life.
That's right.
And absolutely obliterated their natural resources. A lot of these countries could have been very, very successful in their own right if just left to their own devices. But
and what often happened, they would talk to the leader, who would usually be a dictator, and made it clear that if they didn't comply, they might just not only lose power, but they might just disappear. And then there was a series of mysterious helicopter crashes in which presidents just died. There just happened to be a few of them. What a coincidence that was.
Yeah. To be honest as well, he gave a TED talk recently. So I think it was a great book. I read it. It was recommended by one of my friend Ryan years ago. It was really, really interesting book. But the guy, he gave a TED talk recently. So he's still alive and he's still saying what he, said on the book. So interesting.
It's interesting when you look at these other characters who've been arrested, haven't they? Like the WikiLeaks founder. Was that Julian Assange?
Julian Assange,
People like that. It's surprising, very surprising. Maybe it's because it happened so long ago. Maybe that's why he's able to get away with it. But anyway, my book tip this month, you won't be surprised because the subject today was quality investing, and it's The Art of Quality Investing by Compounding Quality. I think I may have mentioned this once before. I just thought it was worth mentioning again because of the subject of today. Now, the author of this book is supposedly Compounding Quality, which is run by Peter Slagers, who's a modest young man but very successful. And he
Close
runs
personal friend, isn't he, Tony?
Well, I like to think so, but he does run a very successful newsletter, which I'd highly recommend. But he's also written a book called Compounding Quality, and that pretty much sums up the way we invest. We do think it's the right way to do it, and it's not just quality, it's over the long term, as Awet was talking about this compounding machine, like with Chris Mayer, 100 baggers. That's what you can get by investing in these quality companies long term. You have to be very patient. You're not guaranteed success every year, but over the long term, we think it really works. So that's a tremendous book to read as well. I'd highly recommend it. So any other comments, chaps, before we go?
That's it from me today.
Not really. Okay. Well, we'll be putting links in the show notes. Please leave us a review on for the podcast on Apple Podcast app, as this helps us rise up the rankings, allows us to attract more quality guests. So all I can say is thanks for your time today. It's been fascinating as usual, and I look forward to the next episode. Take care.
Thank you for joining us today. Please help us spread the word by sharing this podcast with your family and friends. And don't forget to subscribe.